Welcome to this second part of session 1 on our course of to do with P3. Although it's numbered up as session 2, it's actually a continuation of session 1, so I'm going to call it session 1 part 2 because that's the kind of person I am. So if you remember what we were looking at in the previous session is we were thinking about strategy and particularly the definition of strategy. Now, we spent a long time going through that definition of strategy. That's where we got to last time, simply because it's so important for the exam. It's so important for question 1. Now, one of the things that I just have to be honest with you about in this course, because we only have 16 hours, I am not going to be able to cover every page of the notes. There'll be some pages, like the rest of page 13 and page 14, I'm going to ask you to do on your own, to just read on your own. I want to highlight the important parts, the main parts. So we're going to move on to page 15. Now, page 15 is important because it tells us the 3 different... I'll write that up there again. It tells us the 3 different stages that we go through when we're doing strategy. Now, these 3 stages are basically the stages that you get in the exam. Strategic position is always, every single exam, strategic position is question 1A. And it's normally around about 20 marks. We will be covering strategic position in chapter 2 up to chapter 5. So chapter 2, 3, 4 and 5 are going to be about the knowledge that we need that we can then apply in question 1A of the exam to say, how is the organisation doing at the moment? What things in the outside world are going to affect it in the future? Yeah? Now, the kind of things that we're going to look at, who are the key, in fact, I'm going to get rid of that. I will just highlight the key, there we go. Who are the key stakeholders? There are lots of stakeholders, some are more important than others. So who are the key stakeholders? What do they want? What do those stakeholders want? Because if you remember, in our definition of strategy, we said we have to fulfil their expectations. So we have to know who they are and we have to know what they want. Otherwise, we won't be able to keep them happy. We need to think about our resources. That was part of the definition. We need to think about changing the outside world changing. That was part of the definition. The only thing that I have got on the screen that was not in the definition is talking about ratios to show the position of the organisation. Now, we will be looking at that at the end of this chapter. It's nothing new. There is nothing in there that is new to all of you. We're going to look at things like ROCE. We're going to look at things like profit margins. We're going to look at things like liquidity. We're going to look at gearing. Stuff that you have been doing since the F3 paper. Now, I am always, as a marker, I am always incredibly surprised when I come to mark at how poor students' knowledge of basic financial ratios, considering people have done F3, people have done F7, a lot of P3 students must be doing P2. And you get students who do not know how to calculate a current ratio. You get students who don't know how to calculate gearing all the time. So one of the things that we will need to do is we need to calculate some ratios to show, has the company got any money? Is the company successful? Will the company be able to expand? These kind of things. So calculating some ratios. Now, the idea behind all of that, I've called it strategic position on this page of the notes. It could just as easily have been called strategic analysis. You may remember from the previous session when we were looking at some past exam questions, it said things like analyse what's going on for GET. Analyse the financial situation of Ham and Shoes. In other words, it's doing exactly what we're doing in stage 1. This is important because that number is important because this fact in the scenario is important because The reason for doing strategic analysis is because of what we really want to do. What we really want to do is to make a choice about the direction and scope of the organisation. We want to choose what to do in the future. And remember, this was the first part of the definition. So the first few words in the definition of strategy, the direction and scope of the organisation. What do we do next? Now, the thing is, we can't do that unless we know something about the analysis, unless we know something about the position. We can't make a choice. So we have to do the analysis first. Strategic choice in the exam is almost always question 1B. Not always, but almost always. Again, it's usually round about 20 marks, and it'll be chapter 6 up to chapter 9. So chapter 6 in particular is about saying, what could you do next? Well, you could decide you're going to leave something. You could simply say, it is not worth us carrying on in that industry. Let's just leave it. Let's just forget about it. You could decide to do something new. You could say, there's an industry where we can make lots of money. Let's do that. You could say, you know, in the past, our customers came to us because we were better than our rivals, but now our rivals have caught up. Now our rivals are doing the same thing. So let's find something else to be better at. Let's find a different way of being successful. You could decide that you're going to sell your products in different countries. You could even decide that you're going to sell new products. And that's what chapter 6 is about. It's about saying, well, you could do this. You might do that. Here's another thing that you could do. Chapter 7 is about saying, you know what, that one is a good idea. Those are the 4 really bad ideas. So chapter 6 is about giving us what are called strategic options. You could do this, and here's another possibility. And strategic choice in chapter 7 is saying, choose this one. Do not choose that one. So we've got 2 different things. Chapter 8 and 9 are about the numbers that we need to calculate to support that. So chapter 8 and 9 are going to be some management accounting stuff that follows on from the F5 paper. Thought I'd warn you now. Now, the rest of the syllabus, the rest of the notes, chapter 10 onwards, so chapter 10 onwards is basically the rest of the syllabus, chapter 10 to 15, which basically says implement it. Chapter 10 is going to be about marketing. You choose to do some new kind of strategy. What marketing will you need? Chapter 11 and 12 about business processes. You choose a new strategy. How will your business need to adapt? What will you need to do differently in order to be successful? Chapter 13 is about people. Will you need new people? Will you have to train them in a different way? So it's about making it all happen. And chapter 14 and 15 are about changing things. It could be projects, which we have in chapter 14, or big things, which is what we have in chapter 15. So basically, that's the entire syllabus. Now, you'll notice question 1A and B are stage 1 and stage 2. They might also come back in one of the optional questions. I don't know. But normally, question 1C and question 2, 3 and 4 are normally something to do with chapter 10, 11, 12, 13, 14, 15. I can't guarantee that. But I can guarantee question 1A, chapter 2 to 5. I can pretty much guarantee question 1B, chapter 6 up to chapter 9. The rest, I don't really know. Not that it will make any difference, to be honest with you, but that's the approach that we're going to adopt in the exam. So that's the way the course notes are laid out. So the first few things we're going to do is we're going to look at strategic position. Now, before we look at strategic position, we've got a few more bits and pieces that we need to think about as far as strategy is concerned. And the first of them, on page 16, is the first model that we have come across. Johnson and Scholes. Now, in the P3 notes, I don't know what any other lecturer does, but in the P3 notes, every time there is a model that you need to learn, it's got its own little blue box and it's headed up model. so that you know. It's a model that you need to learn. Now remember, said it in the previous session, you must learn it, but you must be able to use it as well. Very important. You've got to be able to learn it, you've got to be able to use it. I think, if I remember correctly, there are about 60 of these scattered throughout the notes, and you must know all of them. A lot of them you already know. You've seen things like Porter's 5 forces before, but some of them, I would guess this one, for example, may well be new to you. Corporate strategy. Corporate strategy looks at the industries which we operate in. So in other words, corporate strategy is all to do with leaving or entering. Corporate strategy comes up a lot. We get this a lot in question 1A, because question 1A is often about doing something new. Now, let me give you an example. And this is something I do with my students in class. Let's imagine that I was to say to you, I will give you some money. I will give you the equivalent in your own currency, because I don't know where you are. I will give you the equivalent of £250,000. I will just give that to you. It's an example. Don't write an email and say, where's my money, David? It's an example. Right. I will give you £250,000 or your local equivalent of that, and you can do anything you like with it. The only thing that I would say is you must use it to start a business up. You must use it to start up a company. Sorry, my nose is itching. You must use it to start up a company, and it must employ, your company must employ at least 3 other people. Apart from that, any business you like, I will just give you the money. Now, if I said to you, if I was to say to you, right, what are you going to do with the money? What kind of business are you going to set up? Whatever you tell me, that's going to be your corporate strategy. It's what business you decide to go into. Now, I've done this with students in class for years, and a fairly common one, I'm going to start up my own accounting business. Fairly common one, I'm going to start up my own training college. I think that's simply because they're in college, they think of that. I had somebody a while ago who was going to start up their own business importing olives from the continent into the UK. Fair enough. Somebody was going to set up a chain of hairdressing salons. I remember that. All of those are corporate strategy because it talks about what industry people are going to go into. Restaurants are another favourite one we get. So that's corporate strategy. Now, in the exam, remember, we want to fulfil stakeholder expectations. If we're a company, we basically want to make profit. We want to improve profits, because the more profit we can earn, the bigger dividends we can give, or the bigger the share price will be. So we should be looking, are there new industries that we could move into where there is more money to be made? Are there existing things we're doing that aren't making much money, and should we close them down? That's what corporate strategy is about, and you get that a lot in question 1A. Now, go back to the businesses I was talking about, the restaurants that we've had, and the accountancy firms, and the training colleges, and the importing of olives. I say that, okay, right, fair enough, that's what industry you're going to do. Now, second question, what's going to make your business, what's going to attract customers to your business? Why should they come and buy their olives from you? Why should they go to your restaurant? Why should they come to your accountancy firm? Why should they come to you? And the students will say, because of this, because some students say, because I'll be cheap. Some students say, because I'll have better quality. But they always come up with a reason. Why should I come to your restaurant? Why should I go to your accountancy firm? Because. Competitive advantage, you may remember from the last session. Why do people come to you? Now, Johnson and Scholes call that business strategy. Business strategy, why should people come to you? Now, this is often, not always, but this is often question 2, 3 or 4. In question 2, 3 and 4, often it is not clear why people are going to a particular company. In fact, in a lot of the questions, the customers are unhappy. And so you have to make things better. So those are two different kinds of strategy. What shall I do? And then how can I gain an advantage over all the other people who are doing the same thing as me? Now, if you remember the last session, one of the things that I said was that you should perhaps read the newspapers. And it's interesting, if you read the newspapers, to think about if a company's doing something different, is it corporate strategy or is it business strategy? Are they looking to do something new, or are they looking to do the same thing but have a different advantage? Are they going to look to be better in a different kind of way? Again, look at your own organisation, whoever it is that you work for. What are they trying to do? And they're probably trying to do a mixture of the two. So you need to be able to, if the examiner says discuss the corporate strategy, you need to know what that means. Operational strategy, that's basically the strategic implementation that we were looking at a little bit earlier. I'm not really worried about that one for today. Corporate and business are the big two. So you have to learn that model. I think that one's pretty straightforward, to be honest with you. The next one is a bit harder. Same pair of writers, Johnson and Scholes. One of the things that I normally get asked at this sort of point in the course is students will say to me, does it matter if I can't remember the names? So does it matter if I can't remember that Johnson and Scholes came up with this idea? And the answer is no. It's simply, if the examiner talks about the three lenses, you have to know what the model is. So if you forget Johnson and Scholes did it, no problem whatsoever. But you have to know what the lenses are and you have to know what they mean. So first of all, let's just say what they are. 3 marks out of 10 in the exam for this. The rest of it's going to be for applying it. Strategy as experience. Strategy is about what we are going to do next. The 3 lenses is about how do we decide what to do next. So this is about how to decide. What shall we do as a company next year? Why don't we just carry on doing what we have always done? That is a perfectly valid way of doing your strategy, and that is called strategy as experience. We did this last year, it worked, let's do it again. And I would imagine that an awful lot of organisations, that's what they do. Now, I'm sure you can see there are good things and bad things about that. The good thing about strategy as experience is you know what you're doing because you've done it before. So that's fairly okay. The bad thing about strategy as experience is it doesn't work very well if the outside world is changing. So if the environment is changing, which if you remember we said it often is in the exam, if the environment is changing, this won't work very well. Because what the examiner will do is he will do something, he'll make the outside world change so that what you've always done in the past won't work anymore. You'll have to come up with something new. So strategy is experience. Strategy as experience is easy because you've done it before, but it may not be the best thing to do. Maybe you need to try something new. Strategy is ideas. Strategy is ideas. Let's do something different. Let's do something different just because it's different. So this could be, let's carry on doing what we've always done, strategies, experience, but let's also do something new. Often in real life, you can do all 3 of these strategies at the same time. So we've always done that, let's carry on. Let's try this bit as well. This, what I'm doing now, is a good example of strategies, ideas. We've never done this before. So we've done the sessions that have been broadcast live over the internet. We've done that for a few years now. But we've never done one that you can watch whenever you want to. So it replicates the live session, but it isn't actually live. So this, what I am doing with you guys now, is strategies, ideas. And then what will I do tomorrow? I will be teaching in a classroom, same as I've done since 1997. That will be strategies, experience. So we do classroom, we've always done that, strategies, experience. Let's add this on, strategies, ideas. Now, what's good about strategies, ideas? Well, the great thing about strategy ideas is it's new, it's different. Companies have to keep thinking about doing different things. What's bad? It's new, it's different, it might not work. And again, if you're reading the newspapers, often newspaper articles will be about companies doing something that's new, because it's interesting. Simply writing an article saying they're doing what they've always done, it's not very exciting. They're doing something new, and there'll often be articles in the papers, they did something new and it didn't work. That was strategies, ideas. So strategies, experience, do what you've always done. Strategies, ideas, do something new because it's new, because it's different. Strategy is design. Strategy is design basically says, let's begin at the end of the definition. The last three words in the definition were fulfill stakeholder expectations. Strategy is design says, right, how can we do that? It might well be that we do what we've done before. It might well be that we do something new. It might well be we do a mixture of the two. But the key thing is, what must we do to achieve the objectives of the organisation? Rather than saying, let's do that because we've always done it. Rather than saying, let's do this because it's new. Forget that. Let's just think, what we're trying to achieve, let's work out the best way to do that. Now, which of those three methods is better? It depends. It depends on the kind of person you are. It depends on the kind of company you're working at. They're all perfectly valid ways of deciding what to do next. So that, remember, strategy, the direction and scope of the organisation in the long term is what you do. This model is saying, how do you decide what to do? Two very, very, very different questions. Now, as an example of this, let's imagine that I go home tonight and I'm talking to my wife and I say, I spent all day in a recording studio talking to a camera. I'm fed up with doing it. I don't want to be a lecturer anymore. I've had enough. Or I don't want to do ACCA anymore. I've had enough of it. And my wife will say, all right, then you can leave your job. That's fine. That's fine. My wife has a good job, so that's not a problem. And she said, well, what are you going to do next then? What is the direction and scope that you are going to follow, David, in the future? What is your strategy for the future? Strategy is experience. What would I say? Well, I would say, okay, I don't want to be a lecturer at LSBF. I don't want to teach ACCA. But I know how to teach. I know how to lecture. I perhaps will just not teach ACCA anymore. I'll go and teach something else. It might be in a college. What could I teach? I could teach history. I could teach, I don't know what else could I teach. I could teach maths. I was originally a maths teacher at school. That's why I originally started. I could just teach something. And that would be strategies experience because it's something I've done before. I can even go back to being an auditor if I really had to. But that would be strategies experience. Strategies ideas. I'll become a photographer. No, I've never done that. I've got a camera and I like taking photos, but I don't really know very much about it. But, I might say, look, I've spent 25 years as an accountant. I've spent nearly 20 years as a lecturer. I'm fed up with it. I'm going to do something completely different. I'm going to take photographs for a living. That would be strategies, ideas. Now, which one of those is best? There is no answer to that question. Which one of those is correct? There is no answer to that question. It's simply a different way of looking at things. I could simply say, I'll do what I've always done. Or I could simply say, here's a chance for me to do something new. Let me do that. Strategy is design. Start with objectives. My wife will say to me, I don't mind what you do, dear. Do whatever, if you want to go back to lecturing, do. If you want to be a photographer, do. The most important thing is we have to earn enough money to pay the mortgage. As long as you do whatever you want to, as long as we earn enough money to pay the mortgage. That is strategies design because it's starting with what is our objective. We have to have the money to pay the bank each month. Now, it might be that I do a little bit of teaching and a little bit of photography. But the key thing is money has to be there to pay the mortgage. That's what you start with. The other two, I start with thinking, I want to carry on teaching. I want to do something new. The final one says, let's start with the end result. The end result is you have to have enough money to pay the bills. Now, what are you going to do to pay the bills? And I could do a mixture of new things and old things. I could just do the old things. I could just do the new things. But the key thing is I'm starting with the objective. Now, think about you guys. Think about what you're... And again, it will depend where you are in your studies. I do appreciate that. Think about your next career move. Or perhaps one that you've done recently. Or, when you changed jobs, what did you do? Did you look for exactly the same job but in a different company? Strategy is experience. If you did, why did you look for the same job? Was it because you knew you could do it? Because you knew it would fit in with your skills? Did you perhaps look at a new kind of role that you'd never done before? Strategies, ideas. Did you do it simply because you thought that's an interesting area? I want to get into that. I think I'll be good at that. Has it worked? Are you happy doing it? Or has it turned out to be a mistake? But that's strategies, ideas. Strategy is design. Maybe when you were thinking about your last job, or maybe when you think about your next job, you say, well, I have to earn this amount of money to pay the rent, to pay the mortgage. I'm not prepared to travel more than this distance, perhaps because you've got a family that you want to get back to in the evening, or perhaps travelling is expensive. I want this, I want this, I want this, I want that. And then you work backwards from there. So, for example, when my wife chose her most recent job, she said it's got to be somewhere that's within an hour's drive. So my wife drives to work each day. So she drives an hour there and an hour back. She wasn't prepared to do further. She didn't want to work in London. So there was lots of things that she thought about, and then and it actually turned out she's doing something that's different to what she did in the past. She's doing a new role, but the most important things were, I must earn this, I must get a company car, I want to drive to work, and I don't want to drive more than that distance. And then she started looking for a job. She did strategy as design. I think I've done strategies, ideas in the future. I've done different things because it seemed like a good idea. The key thing in the exam is you will probably have 3 different groups of people. One of them is saying, let's carry on as we've always done. One of them is saying, no, let's do something new. Or one of them is saying, look, let's meet the objectives. And you will need to identify those 3 groups of people. You'll need to say why they want to do what they've always done, why they want to do something new, and then put them under the right heading. This group are doing strategies, experience. This group are doing strategies, ideas. You might even need to say what's good about what they're doing. In this scenario, in this case study, strategies, experience won't work because... In this scenario, strategy design won't work because of whatever it happens to be. So you need to know the definitions. There's your knowledge, 3 out of 10 marks. But the rest of it is for saying, here is a group, they are doing this because it's going to be good or it's going to be bad because it's applying the model. We saw that in the last session. Incredibly important that we keep remembering it's applying the model. The final bit that we've got as far as chapter 1 is concerned is something I mentioned earlier, which is the numbers, the ratios. And the ratios in the exam, as I've already said, are done incredibly, incredibly badly. I'm not sure there's a word that I can use in polite company to say how upsetting it is that you get students at P3 that cannot calculate basic ratios. You must learn how to do the ratios. Now, when I say learn, you already know how to do it. Revise it. Even if all you do is revise it the day before the exam, that's absolutely fine if that's what you're doing. But make sure you learn them because they are easy marks. They're easy marks in the exam and people don't get them because they don't know how to calculate things. Now, why does it matter? We are deciding what we're going to do in the future. Now, surely something that makes a difference is what's our financial situation? Because I know this sounds obvious, but people forget this. It's an accountancy exam. So the financial situation is going to be very relevant to you. If you were doing a marketing qualification, a lot of the same material that we're going to cover in this course would be in a marketing qualification, but they wouldn't emphasise this bit. They wouldn't really care about this bit. Because you're accountants, this bit is a big deal. So the first thing we need to think about then is, our financial performance, the profit and loss of an organisation. I hope you don't mind, I am old-fashioned, I will refer to profit and loss accounts. I know they're now called statements of income and expenditure, I believe. I may even have got that wrong. I call it a profit and loss account. And we're looking to see how is the company doing. Is it getting better? Is it getting worse? Because that will impact on what we're doing next. If you've got a company that has had rapid growth in the profits in the past few years, what will stakeholders expect next? Even more. They'll have to choose a strategy that will keep profit going up quickly, because that's what the stakeholders, the shareholders, have come to expect. If you've got a company that's making losses, they're not going to be able to choose the same strategies. Their main thing is stop making losses. Let's just do something so that we make a small profit. So it's going to make a difference what strategies we can choose based on what we've done in the past and how well we've done in the past. Now, very, very, very straightforward. And again, students don't seem to be able to do this in the exam. Just look at things. First of all, you often get given a range of years. Right, now let's say, for example, you might be given 2010, 11, 12. Actually, you wouldn't. I'll stop at 2014. You actually, 5 is about the limit. I was going to do a 6th one, but I'll stop at 5. And what students do, it says here, let's look at the change in revenue. So what students do is, revenue went up by 3% between 2010 and then it went up by 2%. Then it went up by, and then rubbish. Do not do that. Just start with the earliest year and the final year. Forget all the years in between. I don't care about them. I will just want the earliest year and the last year. Thank you very much. What's the revenue grown by? Right. Now, just be careful in the P3 exam. In P2, in F7, in F3, you always get given the most recent year. Make sure I've got this the right way around for you guys. You get given the most recent year and then the previous year is on the right. I think that's correct. If I've got that wrong, I apologise. But it's always the same way around. The most recent year is in the middle of the page and the year before that is on the outside. P3, he's not consistent. So he could give you same information, and there's always somebody in every exam, there's always somebody who gets it backwards. So instead of saying profits have gone up, they say profits have gone down. Revenue's gone up, they get revenue going down. So just be careful which way round he's done it, because he's not consistent. Is it left to right or right to left? So change in revenue. Obvious, but you need to do a percentage. Duh, people don't. If I was to say to you, a company's revenue has gone up by $10 million. Is that good or bad? And of course the answer is you don't know, because if it's a small company and their turnover used to be $5 million, then an increase of $10 million is absolutely amazing. If we're talking about Apple, that'd be a decimal point, I would think. They wouldn't even notice an increase of $10 million, to be honest with you. So give me it as a percentage. The percentage revenue has gone up by $10 million. That's a 20% increase. That's a 2% increase. It's a 0.6% increase. Give me a percentage to give me an idea if it's a big figure or a small figure. That's one thing you should always do. Second thing you should always do. Here is a company. Their revenue has gone up by $10 million. That is a 20% increase. Is that good or bad? I didn't tell you everything. Revenue's gone up by $10 million. That's a 20% increase, and it's taken them 25 years to do that. I think we'd now agree that's actually not very good. So give me the change in revenue, $10 million. Give me a percentage. Give me a time frame. Give me the number of years it's taken. 10% increase in 1 year is very different to a 10% increase in 15 years. So, again, I get lots of students, in P3, students will say the revenue has gone up by $1 million. I can't give any marks for that at all. Is that a big deal? Is it not a big deal? I've got no idea. So give me a percentage, give me a time frame. Similarly, changes in profit. Profit has gone up by this, it's this percent over that time frame. Gross net margins. I think particularly with gross margins, I think gross margins are particularly important because a lot of students say to me in the exam, this is what they will do in the exam, they will say sales have gone up by 10%. That's good. Cost of sales has gone up by 8%. Costs have gone up. That's bad. Now, I thought the whole point of cost of sales was that it relates to sales. So if sales go up, cost of sales would go up as well. If you sell more things, the manufacturing costs go up because you're making more things, don't they? Students get cost of sales wrong all the time. All the time they get it wrong. Sales up, good. Cost of sales up, bad. Don't get that, but there you go. So I would just avoid that problem by talking about the gross margin. So as you know, the gross margin is simply sales minus cost of sales. That's your gross profit divided by your sales. If that's going up, sales are going up faster than cost of sales are going up. If it's going down, sales are going up slower than cost of sales. I think it's just easier. Now, with all of these things, you need to give me a comment. What does it mean? Or, why is it happening? So notice what it says underneath this. If things are getting better, it's usually because of the strengths of it's because we're good at something. Now remember, the examiner will tell you what they're good at. So you might be able to say, profit has gone up, and the reason is because they've got a good brand name, and the examiner will have told you there's a good brand name. Or revenue has gone up, and that's because they've spent more money on marketing. So you'll be able to relate the number to what's in the case study. Similarly, doesn't always happen, but this is very common, if things are getting worse, it's because of the outside world. Revenue has gone down by 5% in the last year because there are new rivals that have come into the industry. So number, scenario. Profits have gone down because customers are not willing to pay the same prices they did in the past. So you can relate the number to what's in the scenario. Again, lots of students don't do that. They will simply say revenue's gone down by 5%. Again, I can't. Well, so what? Why has that happened? Yep. So why is it happening, or what does it mean? You could say, when I say what does it mean, you could say something like net profits have fallen by 10% in the last year. This is worrying for the company because they may not be able to carry on in business any longer. So sometimes it's what's going to happen if they don't fix it, and sometimes it's why does it happen. It would depend on the case, depend on the scenario. So the financial performance is all about the P&L. The financial position, on the other hand, is all about the balance sheet. Now, liquidity ratios, current ratio. The one that students often can't do is they can't do the acid ratio, the quick ratio. I don't understand why they can't do it, but a lot of students can't do that one. So current ratio, current assets over current liabilities. Quick ratio, current assets minus inventory over current liabilities. Now, why do we care? It is not for the same reason that you care in F7 or F8. Now let's imagine we do the current ratio and we get a current ratio is 1.05. What does that mean? F7, F8, P2, P7 would all say the same thing. They would all say the company has enough money to pay off its liabilities. And that's correct. But that's not why I care. In P3, I am thinking, you are thinking, about what the company's going to do next. If the company hasn't got enough money to pay the bills, they're going bankrupt anyway. Who cares? What I care, so what F7 and F8 look at is they look at the 1. 1 point anything is good because it means you can pay the bills. In P3, we look at what's after the decimal point, because what's after the decimal point is what's left over. After you've paid the bills, what have you got left? Because whatever you've got left, that's what you've got to spend. That's what you've got to spend on new products. That's what you've got to spend on new markets. That's what you've got to spend on making an acquisition. So in this particular case, yes, 1.05, yes, the company can pay its bills. But it's not going to have an awful lot of money to do anything in the future. So when it's looking at its strategic choices, it's going to have to do something that's inexpensive because it hasn't got any money. That's what we care about in P3. I get sick of students in P3 saying the company can pay its bills. Yes, I know it can pay its bills. I want to know, can they afford to do what the examiner is suggesting? Can they really afford to make an acquisition if they can only just pay the bills and nothing else? Now, some of you will be thinking back to F9, and you'll be thinking, aha, if they haven't got the money, they can borrow it, which is why we need to calculate gearing. And again, students are really, really, really bad at calculating gearing. I know there are two different versions. The one the examiner uses is that one. Debt over debt plus equity. Now, what happens if, let's say, what happens if I'm just going to make up a number. So let's say 75%. All right, gearing is 75%. F7 and F8, the company is risky. The company may not be able to pay its bills. Absolutely correct, irrelevant to P3. If it can't pay its bills, again, it's going bankrupt. It's going out of business. I don't care. I care about what they're trying to do in the future. So the examiner has said, should they make this acquisition? They don't have very much money because the current ratio is very low. Can they borrow it? Well, not with that gearing. They're not going to be able to borrow any more money. So you have to say, I'm really sorry, Mr. Examiner. I'm really sorry, company, but you haven't got the money and you can't borrow it because your gearing's too high. So that strategy, for you, that strategy won't work. You will not be able to afford it. That's what we're doing in P3. We use the numbers to say, can you do this in the future? Now, a typical exam question in P3, and you get this over and over and over again. You have a privately owned company. It's often owned by a very small group of shareholders. Sometimes it's owned by one person. And their liquidity ratios are very low, 1 point something, and their gearing is very high. And you analyse that in the question. You do that as part of your strategic analysis, as part of your strategic position. And then the examiner says in question 1B, they're thinking of doing this. They're thinking of expanding abroad. They're thinking of making an acquisition. What do you think? And you say to them, well, you haven't got any money because your liquidity is low. You can't borrow any more because your gearing is high. And because it's a small private company with very few shareholders, you probably can't do a rights issue. You can't raise any money through equity either. So you can't afford it. So I'm really sorry, but we'll have to say no. We can't make that acquisition. And the numbers are there to help you decide about the future of the organisation, and students completely ignore them. Now, as I said earlier, it's not even F7 ratios, it's F3 ratios. There is nothing complicated, but you must be able to calculate them and you must be able to say what's the significance of them. The gearing is very high, it means this, for this company, or why is it happening? The profits have gone down because of that. If you can do one of those two, easy, easy, easy marks. If you simply say the gearing is 63%, you'll get nothing. So you need to think, why is it happening? Again, it's applying the ideas. Now, the final thing that we are going to do in this particular section is we're going to have a look at a past exam question. Now, at the beginning of session 1, I did say that we were going to look at the question from June 2012, Ham and Shoes. So download it from the internet, or it's in the revision kit. I think it's question 36, if I remember correctly. But I just want us to... I'm going to try and do this at the end of the even-numbered sessions. So remember, to me, session 1 and session 2 are basically the same session. We'll just split it into two. Session 2, 4, 6, 8, blah, 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 will usually end up with a question. Here's the case study then, question 1 from June 2012. Right, if you've got it in front of you, have a look at it, it's fine. If you haven't, and you're looking at it on the screen, that is also fine. But let's just see what you get given. So, there's a sheet of A4. There's another sheet of A4. There's some numbers. There's the requirement. Does that look like a long question? I think that's the shortest one he's ever done. I'm pretty certain that that's the shortest. I don't remember seeing anything less than that. Normally they're about twice as long as that. So if you remember the previous session, I said you need to practice reading and getting faster because there's just a lot there. So first thing that we should do, we should obviously read the requirement. So, analyse. What does that mean? It means do some calculations, tell me what's going on. It says analyse the financial position. It also says evaluate the proposed investment. So we're doing some strategic analysis. Just need to get a different pen. There we go. We're doing some strategic analysis. And then, second part of that is actually a strategic choice. The proposed investment. Is it a good idea or not? So is it a good idea for us to do this or not? Now, all I'm going to do to start with is I'm just going to look at the requirements. So analyse the financial position. Okay then. And evaluate the proposed investment. So, I know this sounds obvious. There are two separate questions, so you're expected to do two separate answers. A lot of students in June 2012 only answered the financial position bit. They didn't answer the second bit at all. So, evaluate the proposed investment. We'll have a look at part B and C in another session. That'll be at the end of session 4 on the internet, session 2. As I'm calling it. So let's just have a look at the numbers. Right, here we go. This is the original question paper, so it stops in 2011. If you've got the revision kit, I would imagine those 3 columns are 2013, 2011 and 2009. It's exactly the same numbers. All we've done is we've changed the years. But this is the original question paper. So let's just have a look and see what's going on. Let's have a look at revenue. Revenue, I can see, I do it like that, revenue is falling, and not only is it falling, it's falling very quickly. Now, I am a big believer in P3 that you should not do any detailed calculations to start with. There is a big danger in P3 that you get your calculator out and you start saying, well, that number's fallen by 27% and that number's gone up by 16%, and you lose sight of what's going on. So first of all, let's just look at the numbers and not calculate anything. Or if we do have to do any calculations, try and do them in our heads. Revenue's falling very quickly. I would be interested to know why that is happening. I wonder whether the case study tells us. Now, I can see that cost of sales is also falling, but to me, it does not look like it's falling as quickly. Revenue's come down from 850 to 700, so it's come down by 150, but on the other hand, cost of sales has only come down by 75. So it's not going down as fast. I wonder why that is. Now, you could just look at the gross profit margin, like I said earlier. Gross profit margin, again, will be going down. I wonder whether there'll be something in the scenario that will talk about why revenue is going down, and whether there'll be something in the scenario that will talk about why cost of sales isn't going down as fast as it could be. Lots of students in the exam said, sales are going down, that's bad, but cost of sales is going down as well, so that's okay then. They're not going down as fast. Now, other things that we've got in here. We have got, for example, finance costs. Finance costs are going up. And they're going up pretty quickly. Now, why would that happen? That's normally going to happen because you're borrowing more money. Why would you be borrowing more money? Well, the company obviously isn't doing very well. Revenue is going down. So why are they borrowing more money? Are they borrowing? Well, why would you borrow money? You'd borrow money to invest. Is that what they're doing? Or are they perhaps doing something else? And then we get our financial position. Trade receivables are going down. So in other words, hopefully our receivables days are going down. Hopefully. We can also see here borrowings and share capital. I can put the two together. Gearing is definitely going to be going up. Gearing's obviously going up because borrowings are going up and share capital isn't changing. So I do apologise, I meant to say this. I should also look in there. Profit is basically collapsing. So this company is doing poorly. I don't know why they're doing poorly because I haven't read the scenario yet, but I know they're doing poorly because the numbers tell me. And what is strategy about? Strategy is about the future. They need to do something. They need to take some kind of action. They need to do something different because what they're doing at the moment isn't working. Now you notice what we're doing here. We're analysing the numbers. We're saying what it might mean so we can then think about what we're doing next. Now, if it was the other way around, if that was 2007 and that was 2011, so in other words, everything's getting better, we would say, great, whatever you're doing, carry on doing it. But the trouble is, what they're doing isn't working. They need to change something. And P3 is all about doing something different. They need to do something different. The numbers tell me that. Now, I say, I've not got my calculator out at this point. I've simply said, well, that's going up, that's going down, that's going up quickly, that's going down quickly, that's going down slowly. Now that I've got an idea about what's going on, now I would get my calculator out. And now I would start doing what exactly is the fall in revenue as a percentage? What exactly is the change in the gross margin as a percentage? What is the gearing? I would do that now, but don't do it to start with. Otherwise, you'll lose sight of what the big picture is. This company's doing badly. Now, I'll try and find this. When I do these questions, sometimes I can find this and sometimes I can't find this. Right, it says the company, it says here, the company is very averse to risk and borrowing. Now that seems a bit strange, considering the gearing has gone up. So I wonder why that is. It also says the company aims to pay all suppliers within 30 days of the invoice date. If you had a look, and I should have said this and I didn't, it's my fault. If you have a look at the very bottom, it tells you that they're completely breaking that. They want to pay suppliers within 28 days, and at the moment it's actually 63 days. Now, something must be going on there because they're breaking a rule that they have set themselves. They aim to pay the suppliers, and it's not happening. So why isn't it happening? Right, let's have a look at this recent history bit. Recent history. Although the Hammond family still own the company, it is now run by professional managers. In other words, the owners don't actually do the day-to-day running of the company. So what have the managers done? The managers have obviously come in and said, the company's doing badly, revenue's going down. Let's just delay paying our suppliers. That will help our cash flow position. And that's obviously what they've done, even though the owners don't like that because they've got other people in to run the company. It also says in the past 5 years, the Hammond family has taken substantial dividends. How are they going to take substantial dividends if the revenue and the profits are going down? Where's the money come from? Where's the cash come from? Well, obviously, they've borrowed it. So the managers have borrowed the money to pay the dividends. Now, remember I said to you a little bit earlier, you need to link the numbers together with the scenario. So I can now say why the gearing has gone up, because they've been borrowing the money to pay the dividends. And I can also say what the significance is of the fact that the suppliers aren't being paid for 63 days. It's obviously cash management. It's to leave enough money to pay the dividends, even though that goes against what the company believes. Now, that's what you've got to do in the exam. You can't simply say gearing has gone up. You need to say why it's gone up, because they're using borrowings to pay the dividends. You can't simply say supplier days have gone up to 63. I know they've gone up to 63 because it says so. Well, so what? The company, the owners of the company, want to pay suppliers. Just they've employed managers who see it as a cheap source of finance not to pay them. Not only that, the company is under increased competitive pressure from overseas suppliers. So that's why the revenue's gone down then, because there's overseas competition. It also says, here we go, the Hammond brothers, this is the people who originally founded the company, they said that they want to have secure jobs and good working conditions. Cost of sales hadn't gone down very much. Maybe that's one of the reasons that they want to carry on paying their workers properly. It also says somewhere, here we go, the last upgrade of the production facilities was in 1991. This question is 2012. So in other words, they haven't updated their production facilities for 20 years. So even though revenue's going down, their factory is old-fashioned, costs aren't coming down, and they believe in treating people fairly, good working conditions, the salaries haven't been coming down. So you can find in the scenario the reasons why the numbers are occurring. Now again, this is incredibly important if you want to pass P3. You can't simply say the revenue has gone down, the cost of sales has gone down, the gearing has gone up. You must tell me why it's happening or what the significance of it is, because that's analysis. Just telling me the number is going up or down doesn't tell me anything at all. That's not analysis. So you need to tell me what the significance of it is. Now, we're going to look at that question again. We're going to look at part B and maybe part C, depending how much time we have. We'll look at that again when we get to the next pair of sessions, session 2 and session 3. But it's useful just having, so I'm not going to write my answer up, only because if you've got the revision kit, you've got my answer anyway. So the key things that we've done today. You need to make sure you are happy. Oops, I need to do that. Oops, I do apologise. There we go. Let's get rid of me just for a second. Key areas from today: strategic analysis, strategic choice, strategic implementation. Remember, those are the 3 stages. Corporate business operational, Johnson & Scholes. The lenses: experience, ideas, design, and the importance of the financial information. They're all important things. When we get on to doing session 2, if my mouse decides to work, and now it's decided it isn't going to. Oh, I need to get rid of that and get onto that. There we go. In session 2, what things impact strategy? This is actually going to be session 2, 3, 4 and 5. We'll start this. We'll be looking at stakeholders. We'll be looking at culture. We'll be looking at the macro environment and the PESTLE model, if you come across that. Looking at the same question, December 2012, June 2012, I do apologise. So we'll be looking at all of those next time. So until then, good luck with all of the studying you're doing. Please, please, please have a go at that question. Hammond Shoes, June 2012, Part A. Even if you just make some notes on it, read through the rest of the scenario, read through the rest of the case study, just so you get an idea of how long it's going to take you, and just so you can see how the numbers and the words start matching up. Until next time then, good luck with your study.